Hi, good evening, everyone, and thank you for joining in the call webinar on our upcoming NFO of Union Innovation and Opportunities Fund. Before we get in the fund side, I would like to introduce my team members over here. On the call, we have our CIO who was joined in yesterday, Mr. Harshad Patwardhan. Many of you would know him from before. He is an old hand in the industry, and he is a pass out from IIT and IM. And his last stint was with Girik Capital. Before that, he was with Edelweiss and JP Morgan. We also have co-head of equities, Sanjay and Hardik, whom you have been interacting before on the webinar. So, starting over, Harshad, you want to say a few things?
Sure. Hi, Saurabh. Thank you for the introduction. Hi, good evening, everybody. Thank you very much for joining on this call. What I will do is I will probably, say a few things, couple of minutes. I know the focus of this call is going to be on our new fund offer. Everyday conversation, people talk a lot about the markets being at close to all-time high. That is the topic of conversation generally. I just want to make one point that markets being all-time high does not necessarily mean that the markets are expensive and therefore bound to correct from those levels. Ultimately, sorry about that. Ultimately, whether the markets will do well or not in the medium to long term is a function of earnings growth and the sustainability of earnings growth. Also, in the near term, markets are also driven by what's happening to the flows in terms of FII buying, domestic buying, etc. So I will urge you not to really equate all-time highs, meaning markets are outrageously expensive. My colleagues Sanjay and Hardik will probably talk a little bit more about our fair value approach and how do the markets look from that perspective. But it's very important to understand right now that a macroeconomic situation in India today, in a relative sense, is probably one of the strongest in the world, and definitely in the emerging market space. If you look at things like fiscal deficit under control, I think Government of India and RBI did a fantastic job during COVID, with the benefit of hindsight, of course, because I don't recall during my career of almost close to 30 years, inflation in UK and US being higher than in India. So I think we did a fantastic job in terms of not really, going the whole hog in terms of fiscal spending during pandemic, and that has paid rich dividends for the macroeconomic stability in the Indian context. Also, it's very important to understand that over the last 7-8 years, the Government of India also has done a fantastic job in terms of various structural reforms. I will not go into the details, but right from GST to PLI to the whole IBC framework, etc. So structurally, I think Indian economy is in a far better condition today. And therefore, we believe that the sustainable earnings growth of Indian economy and therefore the corporate earnings growth is that trajectory is higher than before. And that so market levels you should see in the context of that. And also lastly, as I mentioned, India has become a very attractive destination in the global context, particularly in the emerging market context, because of these macroeconomic positives. I don't think there are very many countries in the world where the expected earnings growth over the next couple of years is in mid-teens. And that is on the back of reasonably good earnings growth over the last 2-3 years. So India remains a very attractive market in the international context. And last point that I want to make, about which I think you guys know much more than I do, which is the domestic investors has become a very, very prominent factor in the overall demand for equities over the last 2-3 years in particular, both through mutual fund route as well as direct route. And I believe that offers a great deal of stability to the Indian markets overall. Indian market is no longer dependent on what just the FIIs are doing. So, I believe that Indian markets are expected to do very, very well over the medium to long term. Clearly other aspects, both my colleagues will cover. Back to you, Saurabh.
Okay, thanks, Harshad. Sanjay, can I request you to give a quick market valuation update, what we call our fair value spectrum, before we come on the NFO?
Sure. Thanks, Saurabh. So on the fair value spectrum, so our partners very well now understand that at Union AMC, we take a lot of pride in looking markets from this fair value angle, and we have been communicating very transparently and clearly about how this fair value is calculated, how various variables go into this, and this is a true 360-degree approach for looking at market. And that's why we have converted this fair value approach into now this very usable and user friendly fair value spectrum. So, in the fair value spectrum, we are considering these five variables of earnings growth, risk-free rate, market required rate of return, riskiness of business, and return on equity. And that is how we are able to make this statement confidently that the market currently, as according to our view, is trading in the fair zone of market valuation. So on the overall market valuation, as Harshad pointed out, that earnings growth and overall situation, macroeconomic situation in India is quite robust. We are looking at double-digit kind of earnings growth likely over foreseeable future, and that is providing good fillip in the fair value calculations as well. And that's why our approach to market currently is that we are positive on overall market scenario. We think that current markets are providing positive risk reward to the investors from 3 to 5 years perspective, and that is what investors should expect when they are investing in the current markets at the current level. There are risks, obviously, geopolitical risks, interest rates which are elevated in the market, overall situation globally, particularly from the interest rate scenario as well as slowing GDP, is quite precarious, and those risks cannot be ruled out. However, at the current macroeconomic backdrop on India and earnings growth are providing us this confidence that current risk reward ratio, which is available to investors, is quite positive. And now this fair value spectrum will be available to all our partners as well as investors on our Union Mutual Fund website as well for their direct usage. Every month, this will be updated on our website. So in the current market scenario, we are positive about market valuations of large cap, mid cap, and small cap equally. We think that all these three market cap parameters are providing equal risk reward ratio to investors from a long term perspective. We are quite positive on sectors like industrial, consumer discretionary, financials, and communication services, and we are negative on utilities and materials. So these are the sectors which we are positive and negative on. You will see our portfolios are having similar kind of allocation across in our diversified products. So with this backdrop, I will request my colleague Hardik to talk about innovation fund. Anything you want to add, Saurabh?
No, thanks, Sanjay. Hardik, over to you.
Great. Thank you, Harshad, Sanjay, and Saurabh. So I will take the audience through a quick presentation on a few slides on this product that we are coming up with. And before I dive into the presentation, let me just give you a quick summary of what this product is. So we were fascinated with trying to understand. We went on a quest to understand what have been the characteristics of, let's say, historical multi-baggers, stocks which have created tremendous wealth for their investors. One common element that was present across these ideas was the fact that over a consistent period of time, if a company compounded its market cap, it was to a large extent driven by consistent compounding of its revenues. Because if your revenues are growing at a fast pace, all things that are good will come across. You will have operating leverage benefits playing through. Your balance sheet will probably make up for the total business growth, and your ROEs will expand. Potentially, valuations will go up, and strength will beget strength, and these companies eventually, end up in a virtuous cycle. So it all started with relatively fast revenue growth potential that was available at the outset. When we look at where this is available today, we are finding these very high revenue growth potential available in ideas that fall under the innovation and opportunities theme, which we will talk about. This is where we are going to see the potential wealth creators of tomorrow. And individually, these companies cannot make up the entire portfolios that currently we have. We can't make up an entire small cap or mid cap portfolio. So we have created a specific portfolio for these kind of opportunities. And to that extent, friends, what we want to indicate is that this will be a true to label portfolio. It will be a portfolio which will not have companies which will on the margin benefit from innovation or from the opportunities that we're talking about. A large part of their story is the innovation and the opportunities that are available in the Indian economy. We are going to focus on companies which are potentially growing their revenues at 2x the nominal GDP. So this is going to then lend strength to the business in terms of potential profit growth, ROE expansion. This will be a true to label portfolio from the perspective that we find a lot of these opportunities currently present in mid cap and small cap parts of the market. So that is where this product will be. And it will definitely be adding a different flavor to an investor's overall bouquet. Without further ado, I will jump on to the slides that we're talking about. We will cover 4 themes that we wanted to share with you, where you can understand why we are seeing a lot of growth potential of companies operating in these themes. This is not an exhaustive list. This is a broad indication of what we are observing and why we are finding these areas to be attractive. And after that, I will hand over to Sanjay to discuss about the certain product characteristics. So moving forward, there are 2 innovative themes that I want to talk about in this presentation. See, all of us have owned cars or have basically been privy to the different evolutionary zones that the cars have gone through, right? From basically having manual rolling up of windows and having to look at our rearview mirrors. Now we have power-driven, a lot of power-driven systems in the car, infotainment systems, having a camera which is giving you the information of how to go in reverse and things like that. And going forward, cars are going to get more and more advanced. The way they interact with the user, the driver is only going to increase. And all this is going to result in very strong growth. A lot of things are driving this shift. One is the overall environment is favorable for this shift. We are seeing electric vehicles basically picking up materially in terms of the prevalence. There is going to be enhanced automated systems available in a car which customers are also asking for because of the rising income levels. And this is resulting in a sea change in the way the particular product is being sold. Now, because of this evolution, you can see that there are some companies that are seeing a very strong growth in their overall business. So let's say now you need more software in a car to basically have the same operations being done. Because when you want to have an infotainment system which shows you different applications, it needs a higher amount of software. More electrical component manufacturers will basically be getting businesses because that's what increases in a car. More wiring harnesses, higher amount of wiring harnesses will be put in the car. We will now be having battery vehicles, which will be a large part of the population 10 years down the line. So any company that manufactures battery chemicals.
Sir, are you able to hear it? You're on mute.
Yeah, I think, Hardik, let's wait for a minute, team. There's some network glitch. Hardik will come back on the call. In the meantime, request everyone to keep putting in questions on the Q&A tab so that we can take it post the one. Sanjay, you want to continue with this by the time Hardik joins in?
Sorry, Saurabh, what you said?
Sanjay, you want to continue with the presentation by the time Hardik joins in? Yeah, okay.
Sure. So, as Hardik was pointing out, there are multiple areas of growth which are. Yeah, can you share it again? Okay, I'll share. Just a second. Give me a second.
Yeah, Sanjay, we can see it.
You can see it?
Yeah.
So, in this area, as Hardik was pointing out, that a lot of new innovative ideas are now happening in the sector because of this change, one change of auto shifting from old ICE engine vehicles towards the hybrid and electric car vehicles. So not only software vendors, electric component manufacturers, wiring harness, battery players will benefit, even EV focused OEMs, charging infrastructure players will also benefit. So innovation is not only touching one area of automobile, only the manufacturer, but whole ecosystem gets the boost. That's the point which we wanted to drive, that when innovation is happening in one sector, overall ecosystem gets the boost, and it provides a lot of opportunities for investors to participate into. Second area which we wanted to touch base was on the internet as an enabler. We have seen in past that how internet penetration has increased in India from 2% to 43%. However, we are just scratching the surface. Incrementally, a lot of growth prospects also appear ahead of us. And this 43% can, in fact, actually, if you look at compared to top 10 nations in the world, it is more than 87% of the population is using the internet as such. And that will also, I'll skip some of the charts because these are pointing to the same fact which I'm talking about. However, this will lead to a lot of ecosystem development over a period of time. E-commerce, classified platforms, fintechs, online intermediaries, digital media players, these will benefit materially from this. But apart from that, geotagging, mapping players, e-commerce logistic players, now we understand that we order from some food delivery apps very easily when sitting in our living room. However, the person who is coming is using these mapping services, is using these e-commerce logistic companies, etc. And the food or the products which we have ordered are reaching to us as soon as possible. So these all ecosystem boosts are actually driven by one innovation, that's how internet has changed, and that is driving these overall changes in the overall ecosystem. So Hardik is back on the network. Just I will request Hardik to continue, please.
Yeah, Hardik, you're on mute.
Yeah, Saurabh, can you enable screen sharing for me?
I think it should be there.
It's already enabled because
Correct. Yeah, sorry for that technological glitch that we had to face. I'm back. Yes. Thank you, Sanjay, for carrying on. So as I understand, Sanjay has already covered the internet theme, but as we can imagine, in both the innovative themes that we spoke about, what we're trying to explain is that the underlying industries which are benefiting from this are seeing a very strong growth in their business. So the industries themselves are growing at 25-30% plus CAGR over the next 5 years. If you look at DRHP of all these companies that have also been recently listed, and we are trying to benefit from companies in the innovation theme this way. Now, not only are innovative ideas the only places where we are seeing this strong growth rate. There are certain opportunities that are available to investors today that are playing out in the economy, which are also seeing this fast growth rate. Opportunities which have been spoken about for a very long time, but their time is now. Now is where we are seeing their actual culmination in terms of fast revenue growth rate. Manufacturing. I think this has been spoken about a lot. And while we know the common points like how the government has supported the whole system through PLIs, infrastructure has seen a big development. Harshad also spoke about some of the developments that he has seen that has happened over his career. But today, if you look at even the development that are happening from the world outside. So there was a very interesting survey done by Bernstein, one of the large research houses that do global research. As per their research, the number of companies taking decision of where they want to set up their manufacturing outside of China, the focus on India has increased considerably over the last 2 years. When we look at MNCs who are trying to take approvals from their boards to do more business with their Indian entities, that is also seeing a very fast increase. So manufacturing truly is picking up, and we are seeing a lot of demand under basically playing out in the companies that are benefiting from this change. Typically, if you look at which industries are seeing this fastest growth or which companies in this space are seeing that fastest growth, industrial component manufacturers, if we have more semiconductors tomorrow, it will be manufactured. When more battery vehicles will ply the road, there are a lot of industrial component companies which will see very strong growth in the products they manufacture and supply to the industries. Electric manufacturing services companies, we've seen that cell phones, laptops, and other products are increasingly being manufactured in India. Large players are coming to India and giving business to Indian companies to manufacture these products for them. Many brands have already tied up. You've read news about them. Battery chemicals, as I spoke about, if more and more lithium ion or even if semiconductors are manufactured in India, we will require a lot of chemicals which will drive this growth. In fact, there has been a big trend of easternization of chemical industry to India, and shift from China is also playing a big role. So these are the industries which are seeing very strong growth. A lot of them are benefiting from PLI and other contract manufacturing opportunities. These opportunities have always been there, but they are really playing out in a big way. And we can see that from the way these companies are putting up capital expenditure and seeing growth in their business today itself. It's not a story of the future. It's happening here and now. Another opportunity that is playing out, and I think this also has been very well understood historically in our country, If our population grows by 1%, but the nominal GDP grows by 10 to 11%, then on average, the per capita is growing by 9 to 10%. An average Indian is getting richer by that extent every year. This incremental spending will get used somewhere. And if you look at this chart, this shows you the speed at which our population is slowly transitioning into from a lower class to a middle class, upper middle class, and wealthier part of the economy. And that means that certain sectors, certain industries are seeing very fast uptake in their demand. Things like, for example, retail real estate. We've all been witnessing a boom in the retail real estate market recently. If you have been talking around, you'll be privy to that. Car ownership definitely has been picking up. The pace at which people are preferring to travel by air, whether they go for business or even leisure trips, that has significantly increased over a period of time. Indians are willing to spend more and more on leisure activities like vacations and all. Quick service restaurants, with the advent of food techs and all that Sanjay spoke about, QSRs are also becoming an indirect beneficiary because we are seeing a higher propensity to spend on these particular avenues of spending. Apart from that, we've seen that certain markets which are more on the consumer discretionary side, on the ownership of things like jewelries or watches and other such accessories, the ownership for them is going up. The choice of moving to more branded apparel. If you remember our presentation of Elephant Can Dance, we told you that the basics have been met. It is what we are really spending on that is changing as Indians. So these industries are also witnessing 2x to 1.9x GDP growth rate, business growth rate as a percentage of GDP. So this is in a nutshell what the product will invest in. These are the areas where we are going to witness there is very fast growth in revenues. And with more details on what the product will actually look like, I will hand it over back to Sanjay.
Thanks, Hardik. So as Hardik mentioned, so these are just the tip of the iceberg. These are some of the themes which we wanted to highlight because innovation can happen in multiple sectors, multiple industries. That's why we are quite confident in identifying such kind of themes across the sectors and constructing a portfolio which is true to the label, which is focused on growth and quality, and which is investing across market capitalizations of large, mid, and small. So in this portfolio, we will be constructing a portfolio which is true to the label, where innovative theme is the dominant theme, and along with that, opportunity theme is also getting represented. We are focusing on the companies which are growth and quality focused. So average age of the kind of a domain which we are talking about is almost 30 years. So these are not fly-by-night kind of operators. These are companies where revenue models, profit models are expected to stabilize very quickly. These companies are expected to have very high ROE, returns on equity potential over a period of time, and which are available at a reasonable valuation. Those will be represented in the portfolio. And the key characteristic of this portfolio is that though this portfolio will be present across large, mid, and small, we are expecting that this portfolio will be tilted towards small and mid cap, where we are able to find multiple opportunities. And that is where the kind of growth which Hardik talked about, which is almost 2 times the GDP, is expected to happen over a period of 4 to 5 years. Next slide, please. Currently, our investment universe comprises of 173 companies, as mentioned in this table, across 11 GICS sector, which is available for our investors to invest. Between that, we have found out almost 70 to 90 stocks, which became the domain for our innovation and opportunity fund. From this, these are the high growth companies, top 70 to 90 stocks which are there in our fund house universe will qualify to be selected for our investors in the Union Innovation and Opportunities Fund. And from that, we are planning to construct portfolio of 50 to 60 stocks. Why 50 to 60? One, it provides well diversified portfolio. It provides presence across the 11 GICS sector which is there. And as on the table on the right, you are able to see, we are able to find opportunities across large, mid, as well as the small cap. And you are able to see that particularly in the mid caps and small cap, we are able to find higher level of opportunities. And that's why this portfolio, we are expecting that it will be tilted towards small and mid cap. And we reckon that this will be one of the key characteristics of our fund once it is launched. Then if this is the characteristic, how do we expect this portfolio to behave, and what would be the salient features, or what investors should look forward to? So we are expecting that investors who are well informed and experienced in this market, because for these kind of companies which are high growth companies, as you can understand, the gyrations in the stock prices have also been higher historically. That's why a well informed and experienced investor who has risk appetite is the ideal investor for investing in this fund. The particular investor who want to have specialized exposure in the disruptive and innovative companies. So these companies will be disruptors in their respective sectors, and also there can be heightened amount of competitive activity which we should be expecting, and that is what will be one of the characteristics of these companies which are present in the portfolio. These companies will participate in the larger India growth story. We have been talking about elephant can dance, and we have portrayed how India can grow at a faster clip over a period of time, and these companies will leverage on India's growth, and across 11 GICs these companies will be present. They have these companies will have higher, these investors should have high risk appetite, because as I mentioned, small and mid cap oriented portfolio would be there, and plus gyrations over in the short term can be there, and that's why the investors who are investing in this scheme should have a high risk appetite as such, and wish to diversify their portfolios not only from the traditional large, mid, and small, but this will be an incremental theme or incremental layer of innovation which this fund will provide to our investors. So with this, I would like to bring the presentation to conclusion, and I would request Saurabh to take over.
Thanks, Harsh, Sanjay and Hardik. We have quite a bit of questions, and we'll take them. So I'll be consolidating questions and going for it. So Hardik, the first question is for you on the on the NFO. Many of the previous innovation fund NFOs have stocks like large cap stocks in common, and now one can argue that there's an innovation happening in a private bank because the way they have done the technology, and these are also part of the other schemes of the fund house in a similar proportion. At Union Mutual Fund, how are we going to define innovation, right? And what do we look in the companies when you're looking at an innovation theme?
Right. So the way we try to tackle this is by setting the bar high for ourselves. So what really classifies as an innovative company? It has to start reflecting in a very fast revenue growth, faster than nominal GDP revenue growth. So we will typically not own a company which has, let's say, 10,000 crores of revenue and 1,000 crores of its business is benefiting from innovation. It's not a company which is seeing some innovation happening in the background and hence is classified as innovation. Our focus is on companies which are truly seeing a sea change in their business. So when we say innovative or company which have an opportunity, their total business itself is going to benefit and their revenue itself is going to grow at a very large scale. So this will be the marquee difference for us to choose which companies will fit in this portfolio. There are companies in the economy. Our economy is changing very fast, and all companies from large to small are trying to do something and benefit from these changes. But for us, what is more important is how much will this change affect the company? Will the company become a multi-bagger over a period of time? Will its revenues keep doubling every 4 years? Things like that. That's the question we are asking to figure out which company should be part of this portfolio. That is why that 2x nominal GDP cutoff was indicated. That is the way this portfolio will be different. And that is why the focus also ends up becoming more on mid and small cap, because that is where such opportunities are lying.
Sanjay, the next question is on the opportunity side. How do we define opportunity? Is it the same that we are looking at 1.5, 2x of GDP growth, or we have a different view of looking at the opportunity side?
Yeah, no, it's a very interesting question, Saurabh. So even in the opportunity side, we are identifying the opportunities which are present in the current construct of the Indian economy, but these are not the opportunities which are likely to wither down immediately in 1 or 2 years. These are sustainable changes. There are certain sectors which are, because as in the presentation it was covered, that even electronic vehicle shift from normal petrol and diesel vehicle is one great innovation which is playing out. But it not only helps personal car manufacturing units, but it also helps electric wiring harnesses. It also helps software vendors. It helps the mapping services. And that's why we are able to find that this innovation, one layer is innovation, but it is likely to benefit whole host of companies which are also slightly away from innovation, but they are not very high innovative themselves. That's why this opportunity layer is added to this innovation theme at Union Innovation Fund. And now we are calling it Union Innovation and Opportunities Fund. So these companies also are likely to, we are expecting that our expected growth from these companies also expected to be very high, at least 2 times the GDP is what Hardik mentioned. And that's what the layer, same kind of construct we are using to identify opportunities as well.
Thanks. And Sanjay, can you also highlight what's the percentage right now between innovation and opportunity currently that we are looking? It may change.
Sure. So we have been running our portfolio in the backdrop to understand how these companies are behaving, what are the opportunities we and our team is able to identify in the background. And currently we envisage that roughly innovation and opportunities theme will be roughly half and half as a percentage in the portfolio. There is no strict regulation or strict rule as to where it would be. Current portfolio is constructed, the current constructed portfolio is having this characteristic, but I must mention that as we find more opportunities on the innovation side or on the other segment, this percentage is likely to change over a period of time.
Okay. Hardik, one of the questions is, and it's a pretty interesting question, will this fund have because there's no, defined regulatory limits on cap or sectors in this fund. Over a long period, does this fund give a fund manager a greater chance to generate alpha over the benchmark compared to other funds?
So
over a long period.
Sure. So this is what I would say, right? So this fund, because it's going to be heavily invested, relatively more tilted towards mid and small cap, that opportunity which exists in investing in mid and small cap exists over here as well. But what I want to really drive is the point that it's not about the kind of market caps that we position ourselves in. These companies have an element of newness. These are companies which are relatively new to investors and the markets, and everybody is figuring out at what price to really buy them. And our fair value approach helps us in figuring out a mispricing, where it tells us that the way markets are looking at these companies is, if these are new to investors, hence they are often times mispriced. And the opportunity doesn't just lie in the fact that the business itself is growing fast. It also lies in the fact that if you are able to value this relatively novel opportunity, which is new to us, we might be able to generate significantly better returns for our investors. So to that extent, that is our hope, given that our tilt is towards companies which are more on the mid and small cap size, which historically has proven to give better returns. And more importantly, there is an opportunity that these companies might also be mispriced. Both these things put together might give us the ability to generate higher alpha. But of course, with the ability to generate higher alpha also comes the higher risk that comes along with it. That is why when Sanjay spoke about, he said that this product is meant for investors who are well informed, who understand this product will behave differently than the overall market.
Thanks. Harshad, the next question is for you. So in the last 2-3 days, we have seen some very interesting events happening across the globe. One was, downgrade of US by Fitch. Then there's a news coming out about Morgan Stanley downgrading China and upgrading India. Right? How do you see these news playing on the Indian markets and in terms of FII flows? Yes, there was an outflow yesterday, which happened. But how do you see this playing out in the near future or probably longer term for India? You're on mute, Harshad.
Yeah, sorry. So I will separate the two questions that you asked. First about US. So clearly, I think as news headlines go, it has the shock element. US getting downgraded. Last time it happened, I'm sure Saurabh, you will recall, that was in, I think, August 2011. So it's happening after 12 years, right? So there is definitely a shock element to this news flow, but on an operating side, normal, how will the markets behave? I really don't see any durable impact. Let's go back 12 years ago. Yes, US got downgraded, but in a decade that followed, US market was probably the best performing market anywhere in the world, right? They did fantastically well in that time frame. Corporates did well, the markets did well. So I really don't think any kind of durable impact on our markets for sure by this downgrade. It's a signal. It's a signaling mechanism. The downgrade is, just by one notch. It's not that. And I was reading an interesting article today that we should remember that countries are not like households which will go bankrupt. Particularly US government, governments issue currency. They are not borrowers in that sense if you consider the Federal Reserve and government together. So I really don't see much of an impact. When it comes to you talked about China versus India, I think various international brokerage firms have been signaling for a long time their preference of India over China. I remember many of them actually switched at the end of last year when China lifted the COVID restrictions. And there was a great deal of expectation that China will see a phenomenal growth after 2 years of very, very restrictive economic activity. So unfortunately, that has not turned out to be true. So they had a one good quarter, and the recovery has been much below what everybody was expecting. And that is what I believe is leading to these kind of actions by the global investment banks. I believe that, and the people that I speak to believe that India is probably a country to be in from a medium to long term perspective. I mentioned some of the reasons that a lot of changes have happened on the supply side in India, which will have a very positive impact on the over the next decade or more. And as as demand picks up, you will see a more durable growth in India. China also, we should remember, in terms of economy, in terms of population, is flattening out, declining. So the growth rates in China over the next 10 years are going to be significantly lower than what they have witnessed over the last 2-3 years. So if you want to look at large growth markets internationally, there are very, very few alternatives to India.
Fantastic. Sanjay, the next question is on the, allocation. What is is there any sector bias in this fund that we are running because of the bottom-up approach? Is there any particular sector which is getting biased in this portfolio?
Our endeavor in this new NFO would be to provide a diversification to the investors. There are innovation and opportunities which are available across sectors. So our endeavor will be to present across the 11 GIG sectors which are there. But however, market construct and the opportunities which are present in any market may have significant bias in this portfolio. And why I am saying that? Because there are some sectors where we find higher level of innovation. For example, manufacturing, which we spoke about, Harshad spoke, Hardik spoke about. Manufacturing is a large sector which is represented in industrial sector, and we may find multiple opportunities. Consumer discretionary can be another area we may find different opportunities. However, just to limit our exposure and to protect our investors from the downside, we may choose to have some limited exposure in some of the areas or some of the sectors we may find limited opportunities. And that is where this portfolio may have some tilt or bias towards some sectors. We reckon that financial sector would be one sector where we may have a limited exposure going ahead. And FMCG would be another sector. Yeah.
Are you looking at normal banks should be part of this portfolio?
We don't envisage as long as these banks change their characteristics materially and technology and innovation becomes the core thread for these banks to go by in foreseeable future. Till that time, we don't see normal banks to be part of this portfolio to the larger extent. We would refrain from participating in such kind of stories which don't have this fabric of innovation and opportunity, which is the core fabric for them and the growth story which they are portraying for the investors. So as of now, we don't see normal banks to be part of this portfolio. We would see that some fintechs or some of the companies which are using technology in a very innovative way, maybe on the processing of the loans, maybe to source the loans, maybe to access the quality of the borrower. And these are the technological innovations these companies are doing and providing as a value addition for the investors. Those companies will definitely be part of this portfolio.
Okay. And like, what's the percentage in terms of weights of a small cap, mid cap, and large cap, the currently what we're running?
So, as I was discussing, the current portfolio which we have constructed would be tilted towards mid and small cap. But as we go live, as we collect money and deploy the money on that day, the opportunities may be different. That's why I'm not able to tell you exact percentage. However, the tilt of the portfolio, we reckon that it will be towards mid and small cap.
Okay. Thanks, Anil. Hardik, there's a question, either one, good one, is that all these themes can be played in the current schemes. What's the point of launching an NFO for the same? Or like, why are we launching NFO? Why don't we, if you are playing all these themes in the current schemes, eventually they will play out. So why NFO for these themes?
So the overlap, first of all, is very low. I'll give this I'll give this answer in two parts. One is, firstly, we are not we already have these stocks in our other portfolios. But if you look at the commonality, the portfolio will be more than 50% different from our individual mid and small cap schemes, right? So first of all, there is differentiation. What we have already in our portfolios, our current existing portfolios, that makes a small percentage of what will be part of this portfolio, relatively smaller. Now, why is it not completely played in those funds? See, there are certain themes that Sanjay already highlighted, certain sectors which we cannot make part of this portfolio. We cannot have traditional banks, pharma companies, FMCG companies. These traditional businesses will not be part of this because they are stable strategic businesses, but not growing or compounding at that pace. So if we were to make our entire small cap or mid cap portfolios full of these kind of names, the risk that we end up giving to our investors will be very high, higher than what they are expected to get when they participate in small cap or mid cap universes. So that is why our small cap and mid cap portfolios are more diversified across different sectors, and to that extent, it is not necessarily playing on this fast growth. And apart from just the small mid cap, as I said, the other risk that we are playing with over here is valuation. See, these companies, as I said, have an element of newness. They are businesses which have not been around for so long. They don't have comparable, companies that have been listed for so long, or even in foreign countries. The growth rates that they're about to witness is very, very different. And people will often get it wrong in terms of predicting how fast they will grow for how long. So there is always going to be some confusion in the market around what to value them at. So the risk is not only about these companies growing at that pace and hence seeing this, but also about the valuation of these companies. Our typical small cap, mid cap, and large cap funds will not have their entire portfolio of these companies because of these risks that are present. That is why a need for a specific product that can have allocation to such ideas, with investors being aware that they are going to be dealing with this. One point that I want to make is there is a question also, I'm trying to preempt this, that innovative companies are considered to be very risky. What we have tried to do through our fair value approach and through our stock selection mechanism, which we tell you that we invest in high quality and high growth, we have tried to reduce the business risk as much as possible. These are companies which have already exhibited success in their business model, are already reporting a very fast growth along with very fast improvement in profitability, are almost generating very high industry leading return on equity or have the potential of doing so. So we have tried to mitigate the business risk. The only risk that we might have to contend with is a valuation risk, which is why there is a need for a separate product on this.
Thanks. I've, while you were giving the answer, I've got a follow-up question on your answer. Is that then why not multi-cap or flexicap fund, which you can play these things over there, because there you have flexibility also. You have in multi-cap also you have positions into large, mid, and small. So that basically, is there a big overlap which will happen between our multi-cap, flexicap, and this fund?
No, the answer is still the same, sort of, for our multi-cap fund also, because there also we are relatively more diversified. We understand these stocks can have relatively very high growth potential and very far-reaching impact on valuations. The characteristic of this portfolio will be very different from what we have in our traditional funds. Now, yes, we do have these stocks in our other portfolios, but the concentration or the availability of stocks in this portfolio will be the highest from such schemes. So I can tell you that the overall portfolio weighted revenue growth and profit growth potential of this particular scheme will be the highest amongst our overall, all the schemes of the Union Mutual Fund House put together. So it is going to be different. We are not playing it in the other funds because they are more diversified and playing a different need for the investor.
Sanjay, the next question is on our market valuation. So while we spoke about the fair value spectrum and we believe that markets are fairly priced right now, the question is if the investor is looking at a 5-year horizon for getting into equity market, this product or any of the other equity product, is lump sum good or STP model good right now? And if STP, then how many months STP one should be doing?
Thanks, Saurabh. So as I was mentioning in terms of fair value spectrum, we are expecting a positive risk reward for the investors who are participating in the Indian market from current levels as well. However, these investors who are entering in this current market, they have to have a medium to long-term horizon when they are looking at equity products, because markets are not cheap. Markets are trading at certain premium to their fair value, though they are in the fair zone. We are expecting that from current levels, if somebody want to participate, they should be opting for 3 to 6 months of SIP route to participate in the Indian market, mainly because markets are not trading at a discount, or they are slightly trading at a premium to their fair value. So that's why first answer is between 3 to 6 months of SIP is the ideal mode to participate in the current market construct. On this product particularly, we believe that investors who are experienced and who understand risk reward quite well, they are the ideal investors for this NFO, and they can participate in this NFO through SIP or STP route. This may be a satellite core in the core satellite portfolio. This can be a part of their satellite portfolio as of now, and as they get more experience with this theme, they may increase their allocation for this particular theme as such.
Sanjay, the follow-up question is, what will be the strategy for deployment of funds? Will we also be deploying it in 3 months' time? Because that's what we are recommending for the STP right now. And or we'll be doing it like a multi-cap fund. When we launch a multi-cap fund, we told people will be investing within a week of the, all of us getting money.
We'll request Hardik to take this.
Sure. So the way we are looking at it is because of our fair value spectrum now being in place, and we have a very good understanding of where we see the markets at any point of time. Firstly, we have to appreciate that the allotment date is going to be about 45 days away from now. So markets can behave in different ways. If we were to get the money today, let's say if I was to make a decision based on that, then we would be allocating the portfolio or deploying it in a measured way. We won't have the same deployment strategy as we had for all our previous products, because those products came at times we were able to time them. By the time we got the approval and we came to the market, the timing was serendipitous, and we basically were able to deploy also at the right time. So it all depends. Even when the multi-cap, anyway, if you guys remember, when we were talking to you, the market kind of remained sidelined for that period, and we were able to deploy at the time when markets were relatively attractive from the day we started our discussion. So if if market remains where they are and 45 days basically elapse, even a time correction will basically mean that the premium in the market has fallen. So the allocation can be relatively more aggressive, and our communication on the fair value spectrum will also be different. The needle will move slightly more towards the attractive zone. So honestly, it will depend on them. But as things are today, if the market continue to be in this fair zone, the allocation will be a bit more measured. All I want to say is that we have a clear allocation strategy in place. Based on different levels at which the market will be, we will allocate the fund accordingly. It could be immediate, it could be staggered. It will not depend on how things look at that point of time. But it will not necessarily be a straitjacket approach that no matter what happens, everything will go on one day.
Thanks, Hardik. Hardik, the next question is on the stock side. So, participants, I'll not be talking about the stock names. While there are a lot of questions on stock names, so from compliance perspective, we cannot talk about individual stocks. In terms of buying stocks in the portfolio, do we have a cap on how much we buy, or what limit we go to when we are building up the portfolio? And also on the sector, do we have internal limits?
Yes. So question as far as, so all our portfolios in Union AMC, we have been very clear about not taking any outlier calls, any excessive calls in any one area. That will be true for this portfolio as well. we will not actively take more than 300 or 350 basis points or 3 to 3.5% position in any one company. That will be the limit. Even if it passively breaches, we typically have, you have seen in our portfolios, in our other funds as well, we keep pruning our position. We don't let any stock become 7-8% of our portfolio in the multi-cap, mid-cap side. Large cap is a different story. So that will be the marquee of this, the landmark of this fund as well. It will be a diversified portfolio. No one theme or one particular stock will become a large part. That is one thing we will ensure here as well.
Thanks, Hardik. There's again a repeat question on generating alpha. So I read out the question. This being a thematic fund gives greater advantage to fund manager in terms of stock picking universe, unlike large, mid, and small or multi schemes, where the universe is limited to stocks ranked on market capitalization. Do you think playing such a having such a flexibility without limited stock picking universe gives you more opportunity to generate better alpha?
So, right. The point, while it may be true from a long-term perspective, because we're trying to position ourselves in companies which will have this kind of a, not only a strong growth potential, but a long runway for growth. I would also want to, so while that is true, I want to caution that it's a thematic product. There can be times when the theme might be out of flavor, maybe for 6 months, maybe for a year. That can be the case. But over the long run, our belief is that if the investor is willing to look through this volatility, he will be able to generate or be able to benefit from the alpha that we might generate from this product. So it also depends upon the investor's risk horizon. Anybody who can elongate their risk horizon can basically benefit from our ability to generate that alpha as well. Given that it's a theme, as I said, there can be periods where the theme might not play, and that is the risk with thematic funds. But as you know, from the AMC's point of view, we have never come out with a product which we didn't think was structurally beneficial for our investors. We never come out with sectoral themes which we could never come back and tell you that you should get out of. This product has been after a lot of thinking that has been launched because we believe it's a structural story. This opportunity in India or in any equity market will not typically die. It will be there. You'll always find opportunities. The challenge will be that for some time, the opportunities or that theme might or might not play out, but over the long run, it definitely will. So to answer the question again in summary, yes, there is a lot of leeway given to a fund manager because of no clear guidelines. But at the same time, please be aware that this is a play on a specific theme which might see its own volatility from time to time.
Thanks. The next question is that already the distributor has clients in manufacturing, pharma, and auto sector funds. Will this theme looking to outperform these sector funds in next 5 years?
So it will be very difficult to specify that whether this theme will particularly outperform one sector or other. So it will be very difficult to mention. We are seeing this as a more of a incremental layer in the investors' portfolios that which will give you additional flavor on the innovation. We think that this theme will be there for a sizable period of time, and there will be sustainable opportunities which will be coming in this theme. That's why we are quite confident that this theme will value add for our investors. But whether it will outperform particular sector or so will be very difficult and will not be right on my part to comment on.
Thanks, Sanjay. And I'd just like to add one thing that, sector funds have their own advantage and disadvantage. And the advantage for a thematic fund like this is that, like Sanjay said, that it's a longer term theme. So there are times when sector fund will give you very outstanding performance, and there are times when they will underperform. That risk becomes lower if the thematic fund is quite broad. And as you have seen in the presentation, the theme is investment for innovation and opportunity, but there's a wide range of sectors that the fund has got. So from that perspective, the risk reward ratio is slightly better than a sector fund for this kind of product. Hardik, the next question is, without naming, there are other innovation funds in the market, and the question is that you would have looked at it. What is the overlap you're looking at your current portfolio which you are running and the competing innovation funds?
So yeah, so from the data that I have at my disposal, the overlap is less than 7%. in terms of AUM. There is hardly maybe a couple of stocks that might be same. So this will be a very different product from as we look at things now. Of course, this comment will be subject to change because markets are dynamic. What we will deploy when we get the money, and at the same time how the portfolios also change will differ. But if currently only 7% is the overlap, you can imagine that the products will be very, very different from each other. That is primarily the reason for that is because the way we are playing innovation is different. We are playing it in a leveraged way, in the sense that the companies are actually benefiting from innovation to a great extent. It is not causing a small change, it is causing a big change in their business. So a change which is large enough to drive a 20% plus kind of a revenue growth or potentially profit growth for them. So if you want to participate in companies like this, the choice of companies automatically becomes very different. So the way we have defined what we are going to play is different. This is then manifested in having higher mid and small caps in our portfolio. That's the tilt. And hence, automatically, as you can imagine, the portfolios end up becoming very different. So overlap, I would assume that if we stick to the strategy we have and the other products stick to the strategy that they have outlined for themselves, there will always be this overlap, or there will always be this differentiation. The overlap will always be minimal. That is my understanding of things.
Okay. Thanks. The next question is, on the benchmark. So while the benchmark for this fund is Nifty 500, thematic fund, does it really matter does the benchmarks really matter because we are playing a particular theme? So if the benchmark is not a theme-oriented benchmark, does it make sense to compare this fund with benchmark while we are mandated to have benchmark? Sanjay, if you...
Sure. So as you rightly highlighted, Saurabh, so this is a very specialized portfolio for nuanced investors who understand risk reward very well. And that's why my understanding is that this portfolio will have very different performance as against our existing products as well as versus the benchmark. Though we understand that we have to have a benchmark, and as per regulatory requirements, we are having one benchmark, but there may be significant deviations between the performance of the scheme when you are comparing it versus benchmark. One, as Hardik highlighted, this portfolio will be small cap and mid cap tilted. Benchmark is large cap heavy. Second is that benchmark is very diversified, almost 500 names in the benchmark, whereas this portfolio will have 50 to 60 names in the portfolio. Diversification also will be very different in the benchmark versus the portfolio. That's why benchmark and portfolio may have differentiated outcomes over a period of time. So I would urge all our partners to look at this portfolio from that lens.
Thanks. Hardik, the next question on the deployment, a follow-up question has come in. That our fair value spectrum gives a fair value of Nifty 50 companies, while the portfolio we are building in this universe is on mid cap, small cap, and very unique kind of portfolio. So your deployment strategy, will it depend on fair value spectrum or the valuation of the stocks that you are getting into this portfolio?
It will be on both. The fair value spectrum, of course, tell us how much should we be invested in overall equity at any point of time. That has been one of the drivers for our other broader dynamic asset allocation products also. So it will first, the spectrum will be used to understand how much should we deploy in equity. And at the same time, our stock specific fair value computation will tell us which opportunities are more attractively priced while doing so. So we will use both bottom up as well as a fair value spectrum to decide how should we allocate.
Yes, Cholan, there's a question on YouTube also. Yeah, so the question has already been answered, but we can repeat it. Companies that we are trying to invest, how old they are in their in their business. So are they new age companies, or like you said, that what's the...
Something do you want to take it? The average age of the universe which we are looking at to invest currently is around 30 years. So that is also providing us a very good confidence that these companies will bring out the differentiation, but these are not fly-by-night operators who are these companies have established revenue models, and their profit models are also either established or there is a clear path to profitability in these companies. So these companies are having average age. When I'm saying average age, that is the day of their incorporation to date. They have completed almost 30 years. If I to just give you a comparable statistic, in our small cap fund, average age of companies around 35. So these are newer companies as against our small cap fund, but not that they are having they have a stronger track record as well to back it.
Okay. So there's a question on existing themes that there's been a very sharp turnaround in last 6 months in the performance of equity funds. What would you highlight the reason attributed to the performance uptick which happened?
Yeah. So we have always communicated to our partners that we follow a very strong growth and quality oriented approach. We continue to have fair value as a pillar when we are looking at our companies. There is no change in the investment process in last 6 months. And that is the investment process which we have been deploying. We continue to deploy with even more rigor in last 6 months. Obviously, there are certain changes which have happened in the market as well. The way we are able to find opportunities has also played out to some extent. There were certain times which we have been talking about that when growth versus value outperformance happens, there has to be outperformance or underperformance depending on the kind of factor which is available in the portfolios. Union Mutual Fund stands as such for the growth oriented companies and the quality oriented companies. When these themes were not playing out in the market, we saw certain underperformance of the themes as well. We think that our investment thought process continue to yield superior, or endeavor is to continue to yield superior outcomes over longer period of time, and that is what is getting reflected currently.
Thanks, Ajay. So what's the percentage of growth companies in our investment universe? Is it majorly toward growth, or we also have value? What we call bargain markets call value. So what's our stand on the value companies?
Sure, we have mix of growth and value companies in our fund house universe, and across our portfolios, we manage this mix of growth as well as bargain. We don't call it value, we call it bargain because of there some unfavorable situation which these companies may face. They may be available cheaper than their fair value. That's why we call it bargain and not value. So we have a healthy mix of growth versus bargain for our fund managers to choose across our portfolio, and we manage value and bargain. Both components are typically present across our fund in our diversified products as such.
So we have covered all the questions. Harshad, Sanjay, Hardik, you have some closing comments. Give there. Otherwise, we can wrap up the call.
Yes, so I'll just say that in our presentation that we made in February called that Will the Elephant Continue to Dance? And we told that in the economy is going through a sea change. So, well, that's the main idea for this product as well, that India is changing fast, and this product is there to help our investors participate in that change and benefit from it.
Okay.
No additions from my side, Saurabh, please.
So thanks everyone for joining in the call, and look forward for your support for the NFO. As usual, you can expect true to label whatever we have talked about. The product will behave in the same way. So thank you for joining in the call.
Thank you.
Thank you.
Thank you very much.